Good morning, everyone, and welcome once again. My name is Anil Jagmohan, Senior Investment Analyst at Nedgroup Investments. I'm at the offices of Ford Asset Management this morning, and with me today are two highly respected members of the investment community. So we have Daryl Owen, who's Deputy CIO at Ford, and Nick Balkan, who's Head of SA Research. And of course, they're both multi-council portfolio managers on the Nedgroup Investment Stable Fund. Gentlemen, thanks very much for joining us. Please do tell us more about achieving inflation-beating returns after the bull market.
Oh, thank you, Anil. It's Nick Balkan speaking. As Anil says, we do have Daryl with me to answer questions at the end, but I'll largely be doing the presentation. Just to reiterate what Anil said, I think the heading of the presentation is actually inflation beating returns after the bull market, rather than the title that you see there. And the reason I wrote that was actually prior to what we've seen, this recent market dislocation. But yeah, to a large extent, there is a bull market that's coming to an end. But when I mentioned this title to a friend of mine, he was kind of adamant that there wasn't a bull market in South Africa. And I think he was right. I think this was when I came up with the title, it was more a global statement about the ending of the global bull market. And in South Africa, we really haven't felt a bull market at all. So there's two reasons for that. The first was obviously there's been no GDP growth in South Africa. No GDP growth means no earnings. No earnings means no share price performance. And that's for the 50% bucket of the all-share index that is linked to South African incorporated shares. The other big reason why we haven't had a bull market in South Africa is because of the rand. It's underappreciated how big a headwind the rand has been for the bull market in South Africa. So 70% of our all-share index is currently offshore related, and obviously the rand has been a headwind for that portion. Another reason is even in the Nedgroup Stable Fund, we have investments in our other foreign funds that has obviously been impacted by the stronger rand. So just to put it in perspective, our global equity fund in 2017 did 30% or almost 30% in US dollars. But when you translate that back into rands, it only was around 10% in rands. So that shows you the difference in the dollar versus rand, that there was almost a 20% headwind of the rand appreciation in 2017. So putting that all into context, I think it was generally a commendable performance to the end of June 18, where we generated just under 7% pre-fee in a 3-year rolling basis and just around 9% on a 5-year rolling basis. Subsequent to June, we've actually seen even better numbers, and we know the way the fund is positioned that we are beneficiary of the weak rand, so we have had pleasing results subsequent to that. Yeah, so looking ahead, I like to summarize my thinking before I get into the detail. I think we're feeling pretty confident that the way the portfolio is structured right now, that we have the ability to generate inflation-beating results in good and bad times. We're not going for a home run, but as I'll take you through in a moment, there are many opportunities to generate that kind of return. But let's start at the beginning. I think as the first slide suggests, I'm not going to go into the detail of the chart, but effectively the blue lines are the length of the bull markets that we've had. So what we did was from the trough of a market fall to the end of a bull market, we've drawn the lines. And you can see that this is probably the longest bull market we've had in 70 years. So it's very long in the tooth. And as the title of the slide says, all bull markets end. And bull markets have different lengths, but in our mind, and using the baseball analogy, we think that this is probably the 8th innings of a 9-innings baseball game. There might be a 10th innings, which is overtime, but generally this is nearing the end. I think probably last quarter, I don't remember the exact words we used, but I think we used something like the 7th innings in the previous quarter. So we're slowly heading towards the end of the game. And we need to understand the implications of the global bull market ending. Remember, this is not a South African bull market that I'm talking about. But when a global bull market ends, it has huge implications for South Africa. So a quote for me that really resonated was in June 18, Ben Bernanke got up at a big presentation and he said that due to the extensive tax cuts of the Trump organization more recently, we've seen a sugar high for the US economy. But as we get to 2020, as the quote continues, Wile E. Coyote is going to go off the cliff and he's going to look down. And I think it's quite an interesting analogy, and I actually think it's quite apt for markets, because Wile E. Coyote goes over the cliff and initially suspends above the ground until he looks down and there's no floor. And effectively that is the same for markets, because we know what happens once he looks down and there's no floor. He suddenly falls, as the next chart will show you. And we know how the story ends. So using that analogy back to markets, earnings are the floor of markets. When there's earning certainty, markets are comfortable, markets continue. When the market sense some sort of earnings uncertainty, it gets jittery. When it downright loses faith in earnings, unfortunately, Wile E. Coyote or the market falls quite quickly. So what generally happens is you have incremental upside when things are doing well. But as we've seen in the last few weeks, when things move, people underestimate the severity of the moves. So you need to be positioned ahead of time for that. And I think the biggest problem is prior to this few weeks, this is a presentation I have done more recently just before the Rand blew out. But everyone really does struggle to call inflection points. And I used examples that you use Bitcoin, you use FANGs, you use even the Cape Town property market. When you're in something that feels good, it's very hard to see the end of it. And people generally extrapolate that good feeling that they have into the future. But it's Ford's job to prepare for the future, right? So we don't know when it's going to end, but we need to position, just like we have been for the weaker Rand scenario, and then it comes through suddenly. So everyone asks us, when's it coming through? When's it coming through? Sometimes we don't know. It could be 6 months, 1 year, 3 year, 5 year. But we do the right thing. We get positioned. We get prepared for the right outcome, and then it suddenly happens. So we understand that. And we spend a lot of time thinking about our asset allocation, because significant alpha generation is actually as a result of asset allocation. When we sit with clients, a lot of the time we get peppered with questions. What do you think about this stock? What do you think about that stock? But at the end of the day, those obviously play a role, and we have a lot of detailed bottom-up research. But it's so underappreciated how much being in control of the asset allocation plays a role in the alpha generation. And that's why we hire PMs that are generalists. So people also ask us the question, why haven't you got a bond specialist? Where, are you managing these sorts of funds in buckets, and who's doing the aggregation? Each PM is a generalist. And the way we see it is each person needs to be an expert in all segments of the market. And therefore they understand the different trade-offs when they structure the portfolio, as I'll take you through on the next slide. So just explaining for those, I'm sure everyone knows, but just to rather reiterate it in case, a real return on this chart just means a return over and above inflation. So when you target CPI plus 4, that's 4% above inflation. So what these real returns on the charts are, is just a general thought of what the different asset classes should do over and above inflation in a normal market. So I didn't go and say, the equity market's overvalued, so you'll get, 4 to 5 because of that. This is just general thought. So the Aussie should do, through time, 5 to 6% above inflation, but it comes with earnings risk, right? If the earnings disappoint, like I showed on the Wile E. Coyote chart, then you don't get it. You can buy a 10-year bond on R186, which is actually only a duration of around 7 years, and you can get 3 to 4% above inflation. More certain, more secure, but it comes with something called inflation risk. The higher the inflation, the lower your real return. That's why I gave around about 3 to 4%, inflation dependent. An NCD, which is a complex way of just saying corporate credit. So if I go and buy Nedbank corporate credit, I can get over and above a cash yield, because there's a corporate risk that I'm taking on. But we're quite cautious in our minds of buying anything that's not that liquid, because at the end of the day, if we do have a market sell-off, we need the flexibility and the liquidity to buy things that have gone down. And one of the most underappreciated things, once again, is choosing flexibility over taking that additional 1 or 2% uplift that you can get from corporate credit. So we've got very low corporate credit exposure in this fund. And then an inflation-linked bond, you can get 2.5%, which is creeping up, interestingly enough, to 3% more recently. But once again, it does come with a guarantee because it pays over and above inflation. But we still think that the 186 at 9% is a better risk-reward place to be right now. And then we go through the other options, and then gold yielding 0. People ask us why we own it. At the end of the day, it is very uncorrelated with markets. Once again, just like we saw the currency, gold will hover around and do nothing, but in a crisis, we'll have heavy lifting and do a lot of work to keep the portfolio stable. So each segment of this asset allocation has a role to play. I just need to emphasize each one at a different time. So as I mentioned in the preamble, I think we expect the heavy lifting to be done by less from actual domestic equities and more from bonds, our foreign exposure, and our gold, which constitutes 68% of the fund currently. And I just put effectively a chart which I took those real returns that I spoke about on the previous chart and just kind of took a weighted average return if we get the average expected real yield from every asset. And you get around 4% real. That assumes no currency depreciation, as we've seen the heavy lifting recently, and that assumes no alpha generation also. But it was just to put it in perspective. Moving to the next chart, I just wanted to hone in on one of the aspects that I spoke about, which is the 10-year government bond. As I said, there are times to be aggressive, and you want to be in equities, and you want to be on the front foot, and you want to be in cyclical equities, and there's times to be in more stable protection type equities when there's earnings risk. And we just think the risk reward of getting 3 to 4% might not shoot the lights out, but it's a great building block to build a portfolio on. Then you can overlay equities and you can overlay other things on top of it. But we think that a bond right now provides a very stable building block for portfolios. So just going into the detail of what that effectively means is when you buy a R186 bond, you're effectively securing a 9% payment per annum in good times and bad, no matter what, for the next 7 to 10 years, effectively on the duration. Then your real yield, as the chart shows, if inflation is 5%, as the bottom of the block shows, you will get a real yield of 4%. If the inflation pushes up to 6.5%, you still get a real yield of 2.5%. Even with the rand going where it's going more recently, we think that, we will trend towards the lower end of the inflation basket because the tough times in the South African growth rates, the companies are going to struggle to pass through a lot of the price increases, and therefore we'll actually remain on the lower end after the blip that we've had with the weaker rand. So as I said, the combination of gold, foreign, and bonds will stand the portfolio in good stead in good times and bad times. It's about structuring a portfolio that can do well in all seasons, and that's sometimes underappreciated. Bringing it all together to finish with, in order to finish the game, you need to stay in the game. And sometimes people forget that simple adage, they always want to be winning. And we believe this is a very long-term game. And there are times to hit home runs and there are times not to hit home runs. So we'll keep it steady, as this chart shows. Steady, continuous compounding over time wins the game. And that's where we'll continue to be. And as we've shown over the last few months, it's actually proven to be very, very good for our investors. With that, it was a very quick summary of where we position, what we're thinking about on the stable fund. And I'm happy, and Daryl is happy to take any questions should there be any.
Thank you very much, sir. Ladies and gentlemen, at this time, if you'd like to ask a question, you're welcome to press star then 1 on your touch-tone phone that will place you in the question queue. If however you decide to withdraw the question, you're welcome to press star then 2 on your touch-tone phone to remove yourself from the question queue. Just a reminder, should you wish to ask a question, you're welcome to press star and then 1.
Nick and Daryl, maybe while we're waiting, I have a quick question which came to mind while Nick was speaking. So, obviously, as you know, emerging markets and volatility has been making news headlines quite a lot recently. So maybe if you can just quickly talk us through how the fund's been holding up, particularly given your positioning.
Yeah, I think it's done well. As I mentioned, I think, as I was saying, the bigger headwind for the fund was actually the rand. Even though we're doing well, it wasn't coming through in the numbers. So now what we've seen is the fund was resilient in dollars, and therefore being positioned in defensive stocks actually meant that we had a positive return when other people were generating negative returns. So I think it's come through very well, being prepared for the flood rather than waiting for the rain to happen. So I think the good thing was, and I think this is a very important point, it was very easy to capitulate, right? So the amount of meetings that we had at the beginning of the year saying to us that we need to change for the changing environment, and the new South African wave has come, and you're going to ride it for the next 5 years. And it's underappreciated the pressure that you feel to not react to that. So a lot of people changed their view just because of that, and we held firm in the view that we had. And to a certain extent, some people questioned and said, you guys are being arrogant because you don't change for the changing facts. But we've always been very flexible, and we've always changed if we believe the facts really did change. So I believe this really wasn't out of arrogance that we didn't change our fund. We had true belief in the positioning of the fund, and it's come to pass that I believe it was correct. So, long answer. I think we positioned well, and we benefited from it.
Great, thank you.
Maybe I can just add to that on the emerging market specifically. We've seen the fallout now in Turkey, so that obviously is going to react. There's always an overreaction. I mean, as we saw, the rand went to over 15.50 to the dollar, and it's actually come back now to 14.20, 14.30, something like that. But the point is that when the rand was at 12, we thought that was overvalued. So we don't actually point forecast currencies. We can't say it's going to be 12 in a year's time or 13, but we felt that it should have been weaker. So where the rand settles, I think there's more of a chance that the rand will settle above 13 than below 13 in the period ahead. And I think that augurs well in terms of how we're positioning the portfolio.
I think that certainly makes a lot of sense.
Having said that, with the recent blow-off in the rand, we have used the opportunity to make sure that our foreign weighting hasn't gone extremely above 30%. So in the last day, there might have been some trimming of foreign to maintain overall offshore weighting. So we're not sitting here doing nothing. We did take advantage of some of the blow-off yesterday. We do still believe it's the right place to be, but we made sure that the balance in the portfolio remained.
Great. Any questions on the line?
Nothing at this stage, sir.
Okay, well, maybe just one more from me, which I think is quite unique in terms of the way Forwards manage money, is that you don't just take your house view equities and plonk them into the portfolio as it is, but you're very careful about saying, people who are invested in the stable fund tend to have a shorter term time horizon, so you actually select your stock quite carefully to include in the portfolio. Maybe a bit more about that.
Yeah, I think it's important. It goes even further than that. It goes through to look through what the foreign funds own. So, right, because our global equity fund does like Chinese stocks and other, and, we have exposures in the global equity fund to a company like JD, we would look through and say, okay, we've got sufficient exposure to a Chinese internet stock in a look-through basis, and we will make sure that we don't have and NASPers in a portfolio like this because it's already accounted for. Yes, we don't own it for other reasons because of exactly what you spoke about, that it's tailored to an investor that wants more certainty of earnings and certainty of performance, and therefore we do select stocks on that basis. But it even goes, as I was saying, further and looks through into the foreign funds and balances the companies that we choose.
Okay, great. Any other questions on the line?
No, sir, there are no questions in the queue.
Okay, great.
Just one more point of clarity. When Nick was going through the asset allocation of the different asset classes, and he mentioned gold a number of times, just to remind you that gold is an ETF. It's not gold shares. We don't buy gold shares today, so it's a gold ETF.
That's a good point. I mean, we haven't owned gold shares since I joined Ford almost 14, 15 years ago, and that's proved to be very beneficial. We believe mining companies in general are just poor long-term investments unless you in the absolute best of breed, end up making money and put more money into digging the pit. So it's all held in a gold ETF.
Okay, great. Thanks very much. We have reached our time, so I think we can call it there. Thank you very much, everyone.